Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the massive amounts of corporate filings that come out every day. In this video, we are going to decode the latest filing from BlackRock Corporate High Yield Fund Incorporated. This filing is packed with details about their operations, their investment strategies, and their financial health, so grab your coffee and let's dive in. This is a filing from the 12th of December 2025, and it is a pretty big one. It is essentially a prospectus and a statement of additional information giving us a deep dive into how this fund operates and what investors need to know. Right off the bat, the fund is a diversified closed-end management investment company. Their main goal is to give shareholders current income and secondarily capital appreciation. They might offer up to 55 million shares of common stock. Now, the important number here is that as of the 5th of December 2025, the fund had about $1.57 billion in net assets. Their common stock is traded on the New York Stock Exchange under the symbol HYTE. Let's talk about costs. In the summary of fund expenses, we see a sales load of 1% paid by you. Then there are dividend reinvestment plan fees like a $0.02 per S-share fee for open market purchases. When we look at their estimated annual expenses as a percentage of net assets attributable to common shares, it gets interesting. Management fees are around 0.77%. Other expenses clock in at 1.56%, but the big one is interest expense, which is listed at 1.50%. This reflects their use of leverage. The total annual expenses after some waived fees come out to 2.32%. This is a crucial number to remember as it impacts your potential returns. Now for the financials, this table in the financial highlights section shows us how the fund has performed over several years. For the 6 months ended the 30th of June 2025, net investment income was $0.36. Per S-share, net realized and unrealized gain was $0.13 per S-share. Total expenses to average net assets after fees waived is 2.32% for the 6 months, ended the 30th of June 2025, which aligns with the expense summary. Net assets at the end of June 2025 were about $1.55 billion and borrowings outstanding were $458 million. This gives us a clue about their leverage strategy. The fund itself was incorporated in Maryland and has been around since 2003. Its common shares trade on the NYSE under the symbol HYTE. The fund is authorized to issue a massive 250 million shares. As of the 5th of December 2025, they had over 163 million shares outstanding. An important point here from description of capital stock is that shares of closed-end investment companies frequently trade at a discount to their net asset value. The fund's shares have indeed traded at both premiums and discounts in the past. The last reported sale price on the 5th of December 2025 was $9.45, while the net asset value was $9.68, showing a slight discount. Now let's talk about leverage. The fund currently uses a bank credit facility, and as of the 5th of December 2025, this leverage was about 21.26% of their managed assets. They can use leverage up to 33 1/3% of managed assets through borrowings or debt securities, and up to 50% through preferred stock. The document warns that leverage amplifies both gains and losses, making the fund's NAV and market price more volatile. They also mention that the management fee is calculated on net assets plus leverage proceeds, so using leverage increases the dollar amount of the management fee relative to net assets. The risk section is extensive and crucial. It covers general risks like market volatility, credit risk, and interest rate risk, but it also goes into specific risks. Senior loans risk is a big one, highlighting the speculative nature of below investment grade senior loans. There is a lot of detail on mortgage, related securities risks covering everything from credit risk to prepayment risk, and the specific dangers of investing in RMBs and CMBs. They also detail collateralized debt obligation risks, and the risks associated with REITs. There is also a significant section on emerging markets risk detailing the heightened volatility and political instability inherent in these markets. Foreign currency risk is another key area, as many of their investments might be denominated in non-US currencies. Then to raise a whole lot on derivatives and strategic transactions, including swaps, options, and futures. These are complex financial instruments, and the filing spells out the associated correlation, counterparty, illiquidity, and leverage risks. The Dodd-Frank Act is mentioned in relation to OVA. Counter derivatives raising compliance costs and potentially limiting trading activities. Rule 18F-4 under the Investment Company Act is also detailed, which imposes stricter rules on asset managers using derivatives. Looking at management, BlackRock Advisors LLC is the investment advisor, and BlackRock International Limited is the sub-advisor. The management fee is 0.60% of net assets plus leverage proceeds. Notably, the advisor has contractually agreed to waive its management fee on certain affiliated fund investments through June 2027. This helps manage overall expenses. The net asset value or NAV is calculated daily. Equity securities are valued at exchange closing prices or last traded prices if a closing price isn't available. Fixed income securities are generally valued using bid prices from dealers or evaluated prices from third-party services, incorporating various market data. Options, futures, swaps, and other derivatives are valued using market quotations or mathematical models. The use of fair value pricing is also explained for investments where market quotations aren't readily available, and it acknowledges that this can lead to subjective valuations. The fund intends to make regular monthly cash distributions. They have a managed distribution plan to support level distributions of income capital gains and return of capital. They emphasize that shareholders should not draw conclusions about investment performance solely from distribution amounts. The fund may offer rights to shareholders to purchase common shares. This portion of the filing details the terms and risks associated with such rights offerings, including potential dilution and the fact that shares might be offered below net asset value under certain conditions. For us shareholders, the fund aims to qualify as a regulated investment company or RIC to avoid corporate level taxes on income and gains it distributes. Distributions are generally taxable as ordinary income or long-term capital gains. Any return of capital distributions will reduce your cost basis in your shares. This section details some of the fund's corporate governance provisions which could affect shareholder rights, like supermajority vote requirements for certain actions and rules around director elections, all designed to ensure stability and protect existing shareholders. This section is critical. Investors need to understand potential conflicts of interest. BlackRock manages many accounts and advisory activities. Conflicts can arise when BlackRock's business interests or the interests of other clients might differ from those of the fund. This can happen in areas like allocating investment opportunities or managing proxy votes. They state they have policies and procedures to manage these conflicts, though acknowledging potential for favoritement is always there. This is where they list pretty much everything that could go wrong. We already touched on derivatives, but they go into extreme detail on the risks like correlation risk, counterparty risk, and leverage risk. There are detailed explanations for senior loans risk, second lien loans risk, mezzanine investment risk, and the risks associated with managing loan assignments and participations. Bank loans risk, volume and ratings risk, and unrated securities risk are also covered. They specifically warn about debtor in possession financings and the risks associated with mortgage-related securities. The section lists risks for asset-backed securities, collateralized debt obligations, REITs, zero-coupon bonds, pay-in-kind bonds, sovereign government debt, and inflation index bonds. They discuss risks associated with market disruption and geopolitical events, including specific mentions of the Russia-Ukraine conflict and trade tensions. Regulation and government intervention risk is also highlighted. Here we get some insight into the executive team. The portfolio managers David Delbos and Mitchell Garfin have significant experience and are responsible for managing billions in assets. The management agreement details compensation and the fee waiver arrangement is reiterated. This section elaborates on how the fund values its assets, including equity, fixed income options, futures, and other derivatives. It talks about how market quotations are used, and when fair value pricing is applied, which can involve estimations and subjective judgments. The fund's distribution policy is clear. They aim for level monthly distributions, which might include income capital gains and return of capital. They caution investors not to interpret distribution amounts as a sign of investment performance. There is a standard dividend reinvestment plan, making it easy for shareholders to reinvest dividends into more shares. The fund may conduct rights offerings, allowing existing shareholders to buy more shares. The document details the process and the potential for dilution. If shareholders do not exercise their rights or if the offering price is below net asset value. This section goes into detail about the US federal income tax implications for both the fund as a regulated investment company, or RIC, and for shareholders. It breaks down the tax treatment of dividends, capital gains, and return of capital distributions. Here we found some interesting clauses covering anti-takeover provisions, classified boards, and supermajority voting requirements. These provisions could make it harder for a hostile takeover or a change in the fund structure. It reiterates the nature of a closed-end fund, explaining that shares are traded on an exchange and can trade at a discount or premium to NAV, unlike open-end mutual funds. The board may consider repurchasing shares to address discounts. This section discusses the possibility of the fund repurchasing its own shares, which could reduce discounts from NAV, but might also increase the expense ratio due to fewer shares outstanding. This describes how the fund might offer and sell its shares through underwriters, dealers, agents, or directly to investors. It lays out the compensation structures for these intermediaries. This is a standard SEC filing practice where previous filings like annual reports and proxy statements are referenced as part of the current document. This outlines the fund's commitment to protecting shareholder privacy and how personal information is handled. This is a more condensed version of the prospectus summary. This section in the prospectus supplement is similar to the one in the main prospectus, but might be tailored to a specific offering. This section explains how the money raised from the offering will be invested. Pending investment, the proceeds will likely be placed in short-term high-quality securities. This table will show the fund's financial structure after accounting for the shares being offered. This is a more detailed look at how the securities are being sold, mentioning the role of a dealer manager and selling group members. This section covers legal opinions and counsel involved in the offering. This is a standard disclosure tag for business contact information. This appendix often provides further clarification on risks mentioned earlier in the document. As we saw in the main filing, the risk section is really quite detailed. One thing that stands out is their approach to ESG, or environmental, social, and governance factors. While the fund doesn't have a specific sustainability objective, they will consider ESG factors as part of their investment process, viewing it as a way to enhance risk-adjusted returns. This is becoming increasingly common in the investment world, signaling a shift towards a more holistic view of company performance. Looking at the portfolio management section, we see Messrs. Mitchell-Garfin and David Delbos are key figures managing a substantial amount of assets. Mitchell-Garfin CFA has 29 other registered investment companies and 25 other pooled investment vehicles under his management, totaling over $42.58 billion in other registered investment companies alone. David Delbos also manages a large number of accounts and assets. Their compensation includes base salary, discretionary bonuses, and deferred stock awards. They also participate in BlackRock's incentive savings plans. This is a really important part of understanding any investment fund, especially one managed by a giant like BlackRock. BlackRock manages a massive amount of money across many different strategies, and they serve many clients. This filing frankly lays out the potential conflicts that could arise. For example, they might invest in companies where BlackRock itself has a financial interest, or they might have different advice for different clients regarding the same security. They emphasize that they have policies and procedures to manage these conflicts, but it is always something investors should be aware of. They also mention that they might vote proxies in favor of companies if it benefits other parts of BlackRock's business, even if it is not directly aligned with the fund's interest. This agreement outlines the terms between the fund and the investment advisor BlackRock Advisors LLC, as well as the sub-advisor BlackRock International Limited. It details the management fee structure and the fee waiver agreement, which is set to expire in June 2027. This appendix essentially defines what the different bond ratings mean from agencies like Moody's, S&P, and Fitch. It helps investors understand the creditworthiness of the fund's investments. For example, a AAA rating signifies the highest quality with the lowest credit risk, while a double CC rating indicates substantial credit risk. This section details the fees associated with filing this registration statement. It looks like they paid around $135,000 in fees for CC listings, accounting, and legal services. Now, looking at it all, BlackRock Corporate High Yield Fund Incorporated operates in a very complex financial landscape. They leverage the tools of active management, including derivatives, and a broad range of investments from high-yield bonds to mortgage-related securities. The fund strategy, as explained, aims for current income and capital appreciation, but comes with significant risks, including those inherent in leverage emerging markets and complex financial instruments. The financial highlights show some fluctuations in net asset value over the years, with a notable drop in 2022, which is something to watch. Their expense structure is fairly standard for a closed-end fund, but the reliance on leverage means interest expenses are a significant factor impacting the overall cost. A key takeaway is their robust risk management and the extensive detail in their risk factors section. They are very upfront about the potential downsides of their investment strategy. The conflict of interest disclosure is also extensive, signaling a commitment to transparency in a business where such conflicts are inherent. Finally, the fees and expenses demonstrate a continuous effort to manage costs through waivers, which is a positive for shareholders. Overall, BlackRock Corporate High Yield Fund Incorporated presents a strategy focused on generating income through high yield and leveraged investments. Investors should be aware of the amplified risks and costs associated with this approach and carefully consider the fund's risk disclosures and expense structure before investing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.